This video focuses on the call option. The first three slides focus on vocabulary in common between the call and the put option, but there's a separate video on the put option. So we're going to be looking at what is a financial call option and the concept behind it to start off with. Think about the fact that what you'd like to be able to do is know for sure something is worth buying. So it'd be nice if you had a time machine, allow you to go forward in time, check out whether it's going to make money for you, then come back to the current time and then purchase the security. The call option works the same way. Like the time machine, you'd have a price to pay to get on the ride. With the call option, you have to buy the call option. Only instead of riding forward, what you're allowed to do is hold the price at today's price and then go through life until later at the expiration of the option. At that point, you have the choice. You can either buy the security at the original price in the contract or not buy it. So in that sense, it's like a time machine. Put option allows you to sell a security based on a drop in price. If the price doesn't drop, you're not forced into selling the security. In terms of vocabulary, there's going to be a buyer of the option, and the buyer of the option is actually buying a time delay on the decision. I don't have to buy it today. I can wait for a period of time to get more information, make a better decision, and a wider decision. The writer of the obligation, the writer of the call, the writer to put, is the obligated person. They have to go through with the deal. If it's a call option, the writer has to sell the security. If it's a put option, the writer has to buy the security from the buyer. Expiry is the time to expiration, time that you're gathering information. The agreed upon price is called the strike price or the exercise price. That could be today's price or some other price agreed upon by the two parties. In terms of the price of an option, it's made up of three components. Because there's a time delay, there's time value, and the maximum time value you have is at the beginning of the option when you have maximum time to gather information. As you proceed closer and closer to expiry, the time is decreasing, so the time value also decreases. Volatility is really a measure of uncertainty. The greater the uncertainty that there might be big gains or big losses. Big losses you avoid, big gains you gain. So larger volatility increases the value of the option, therefore increases the volatility value. Decline in uncertainty, decline in volatility value. The intrinsic value is either zero or positive. You don't exercise the option to suffer a loss. So if you'd have a loss, you don't exercise it, has zero value, or it may actually be actually at zero value, or it has a positive value. That's the terminology in common between the put and the call. Now switching to the call option. We'd like to learn the terminology called in the money, out of the money, at the money. In the money means it currently has a paper gain. At expiration, it will be a realized gain. At the money, it has neither a gain nor a loss, but it might become a gain, might stay a loss. Out of the money, it's definitely losing money, and you avoid that loss by not exercising the option. Looking at our example, you are the buyer of the call option, which expires in 21 days at time to expiry, 21. You can buy 100 shares of stock at the strike price, $20. So this is a call option. You can buy the stock at $20. There's a line that has a kink on it. You'll see the green where the green and red intersect. That's called at the money. The reason it's at the money is the stock price is $20. The strike price is $20. You make no money. You lose no money if you exercise the option. If we go down towards $18, buying it in the option for 20 when it's only worth 18 would be overpaying. That would be a loss. So you don't exercise the option. So we designate that red portion of the line out of the money. The other direction, if you kind of imagine that red line extending out to the right, so the zero value extends out to the right, then the green line is where we call in the money, and the space from, if you extended the horizontal line up to the green line, that's the size of the amount of in the money you have. That would be the intrinsic value. So that line that we've just talked about is the intrinsic value line. It is either zero because it's out of the money, zero because it's at the money, or it has a positive value because it's in the money. So let's look at an example with this. Let's assume we have 30 days to expiration. The intrinsic value is $20. So if we look at the first thing, what we see is market price minus strike price is $3. $3 is positive. So we know that the intrinsic value is $3. And we would say this is in the money. The market price is $20, the strike price is $20, so it has no value, but the intrinsic value would again be 0, and we'd be at the money. And lastly, $16 market price, $20 strike price. If you exercise the option, you'd lose $4, but you choose not to exercise the option, so it has 0 value, and we would say this is out of the money. So I think you have an idea. Intrinsic value can be positive in the money. It can be numerically 0 at the money. The intrinsic value would be negative. We don't exercise it, so we didn't say the intrinsic value is actually 0. If we look at this picture, we see the black intrinsic value line. We see a red line, which we call the price line, and a blue space between the intrinsic value and the price line is called potential value. And potential value is the time value and the volatility value. So that space is always shrinking over time because time is running out. An increase in volatility, the price line rises. A decrease in volatility, the price line declines. So that's the picture that we'd have. We can see that the two extreme ends of the red line are very close to the intrinsic value. So when it's very far out of the money, very little chance of it becoming in the money, so the price is relatively low. We go to the in the money. An option that's deep in the money has basically obtained all its potential, so there's very little potential left, so the space between the intrinsic value line and the price line gets very narrow. The widest is at the money because you have a great amount of uncertainty. Will it go into the money? Will it not go into money? Will you make money? Will you not make money? Greatest amount of potential. So let's look at an example where we can come up with the call price. I've given you the time value. It's just invented numbers for this example. The volatility, likewise, an invented number. First thing we're looking at is what is the intrinsic value. Well, market price minus strike price is $3, so we have that $3 intrinsic value, plus 25 cents for time value, plus 10 for $3.35. So the call option is $3.35. If we go at the next one, it's 20. Strike is 20, has 0 strike minus market price minus strike price, so the intrinsic value is 0. And since the intrinsic value is 0, all we have is time value and volatility value, which would be 25 cents, and 45 cents, which would be 70 cents. Now, in the last one, we have intrinsic value that should be 0 because of the decline in all these negative value of market price minus strike, so that's 0. But we see there's very little time value, very little potential value, so it's worth about 10 cents. So the in the money is worth $3.35, 35 cents more than the intrinsic value. The at the money is worth 70 cents because the intrinsic value is 0. Notice that it's very much higher in the sense that it's 70 cents above the intrinsic value. The $3, it's only 35 cents above the intrinsic value. And out of the money, only 10 cents above the intrinsic value. So now we're going to be thinking about, should we exercise, should we not exercise? And we're taking on both the writer's view and the buyer's view. First, we want to know what is the break-even price. The break-even price is going to be the strike price plus the price you paid for the option. You paid for the call $1 per share, and later at expiry you pay another $20. In total, you pay $20 plus the $1, $20, $21. For you to make money, the market price must exceed $21 at time of expiration. So the call option in this example has a strike price of $18. The call price is 75 cents, so we add the two together, and the break-even is $18.75. The buyer's view at expiration is the stock will exceed $18.75. The buyer recovers the price he paid for the call and makes some profit. The writer's view at the expiration, the price will be less than $18.75. It could be higher than today, but less than $18.75. So the writer keeps part or all of the premium or price that it was received for the call option. Premium is another word for price. So if we take a look at this example, we have all numbers in here, but we're going to do two steps. First, we're going to calculate the intrinsic value to see if it's in the money, at the money, or out of the money. Then using the break even, we'll see whether we would be making money or losing money as the buyer. So if we look at this example, the strike price is 20, the call price is 335, the break even is $23.35. The market price is 23.20, which is less than the break even, but the 23.20 is greater than the 20 strike price. So we're collecting $3.20, but we paid $3.35. So exercising the option would give us cost recovery. The second one is $25 plus $1.70 for the call price, gives us $26.70. It's trading at $26.50. Again, market price exceeds the strike, so by $1.50, so we'd exercise it. Again, we've only recovered $1.50 of the $1.70. The remaining 20 cents stays with the writer. Third one, C, is $15. It's below. It's giving you only a 10-cent call price, so it must be out of the money. So the break even is $15.10. It's exactly $15.10. So there is no money in this setting. What's going to happen is if we look at the intrinsic value, the option will be exercised. The buyer gets 10 cents more than the market price, so he exactly breaks even. D, the last one, is $13 plus $1.50 is $14.50. $14.80 exceeds $14.50, so it's going to be, for the writer, full recovery of his $1.50 plus a 30-cent gain. We can see that by $13 from $14.80 is $1.80, so he's getting back $1.80 but spent $1.50, which is a 30-cent gain. Okay, so let's use this through three scenarios, this concept. You pay the option $1. You pay for the option $1 to buy a stock at 20. Break even is $21. At expiration, stock is 23. What should you do? Well, 23 is greater than 20, so you're going to exercise the option. So that's the first thing we're doing. All right, how much profit do you make? Well, we can see that in this story, what we're going to do is exercise the option. So we're going to have a $3 gain minus the dollar we paid, which gives us a $2 gain. If there's a $2 gain, then the writer has to have a matching $2 loss. So we'd exercised, and the buyer made money, the writer lost money. Second scenario is the price is $20.70. So $20.75 is greater than 20, so you're going to exercise. And we see that how much is the profit? What we're going to see here is we're getting back 20 minus $20 from 20.75 gives us, we're getting back 75 cents. But we paid $1, so we have a loss of 25 cents. We can see that also that the $20.75 is below the $21, so again we failed to recover the 25 cents. So in this particular case, the writer has a gain of 25 cents. Last one of these is the market price is $19, which is less than $20, so we don't exercise. So is there any profit? No, there's actually a loss of $1. So the buyer has a loss of $1, and the writer keeps the entire amount. So the writer has a gain of $1. So in this particular case, we've covered all that's concerned about the option. We've covered the vocabulary. We've covered the concept of break even, and we've learned how the allocation of money goes between the buyer of the option and the writer of the option.